Good evening, friends. I am your host, KK Gupta. I am a director in Association of Financial Advisor of India and also research in India, which is a leading investment banker. This association was formed in September 2021 with the sole aim to educate the stakeholders, bankers, and our members in respect of financial positions. We hold about 14 webinar under the series from January 22, and with the demand of our members and our stakeholder, this webinar is arranged. Impact of raising interest on lending to the borrowers. Friends, you are aware the Reserve Bank of India on 8th May raised the repo rate and CRR. Repo rate increased by 0.40 from 4 to 4.40% and CRR by 0.5%, 50% to 4.50%. You must be aware that from 1st August 18 to 6th February 20, Reserve Bank reduced the repo rate by 1.35 basis point, which was from 6.50 to 5.15. Further, during COVID periods, when we're talking about the February 20, when Reserve Bank had come into various measures to pump liquidity into the banking sectors, either you talk about the Rapport or emergency line of credit, providing the restructuring. During that period also, Reserve Bank decreased the repo rate from 4.40% to 4. That means total basis during a COVID period, which was 5.15, come to 4%. That means during COVID period, 1.15% basic point was reduced. Now you feel that inflations is touching about 7% due to the crude oils, food positions in a world. Another factor, whether you talk about the metal, other things, due to Russia war, inflation going up. So Reserve Bank has a monitoring tools in their hand to increase the repo so that cost of lending to the banker increase. In that basis, bank will also increase the lending rates. That means sucking of the liquidity from the bank due to increase in CRR, which was 0.50 basis point, it is estimated that 87,000 crore rupees will be sucking from the banking sectors. That means liquidity in the banking sector, lendable amounts to the borrower will also reduce. It will create having the reduction inflation control measures government is taking. Beside various steps So we are going to discuss in details. When we are talking about the repo rate, so you must be aware that a small business loan they are linked to repo rate. Once repo rate increase, immediately lending rate to my small business will also increase. It is going to affect the borrowers. When we are talking about SME sector or a small borrowers, which are playing very dynamic roles in the development of the economy, that is also going to play. So our member was suggested that we should discuss the effect of increase in repo or CRR and other aspects. So we have eminent personality with me. We are with me Mr. M. Narendra, former CMD of Indian Overseas Bank, who will discuss what is the effect of this interest. So we are with us Munish Jain, who is Managing Director in Finman Advisors. So he is also the right person to talk. How he is helping the borrowers for rating. Because rating is also important tools. While the bank is deciding the interest rate, beside their own rating tools adopted by the banks, they depend upon the rating of the rating agencies. For Mr. Maurice Jain is playing very important role, and he will discuss with us in practical shapes how a rating can be increased, what are the methods where we should adopt so that rating can be increased, investment grade can be there, or more than investment grade, A, A plus, or double A, or triple A, how they can do it. I think he's the right person to talk about the ratings. So we are with us CA, Siddhartha Prabhu. He is Executive Director in Swagat Housing Finance Limited. It is one of the NBFC. I am happy to announce, to inform that he played very important role in financing a small housing, affordable housing. And he is the person who arranged the funds to some Rediwala who I know financial stake, who I know financial information, other person organized sector. I think he is also playing very important role in development of the economy. We are with us Mr. Gandhi, who is also main person for financing the arranging finance for the infrastructure, hotel industry, because hotel industry, hospital industry, some banks, financial institutions are elected. So we'll also talk to him how the infrastructures or hospital industry will be affected by increasing the repo. It is also envisaged the repo may further go up to achieve the 5 trillion economy. So what are the factors? Whether inventory control or sale of the non-current assets, which is not usual by the industry, or other neither we can adopt it so that the borrower can be benefited. I think this will be a practical session. So I hope your expectations for attending this webinar will be met by the speakers. So I'm first of all, I'm requesting respected M. Narendra sir. Sir, what are the broad implications of increase in repo rate and CRR for the economy? Because once As we envisage, as we see, from 1st August 18, continuously the repo rate decreased, which was 6.50%, came to 4%. That means 2.50 basis point decreased. And what was the necessity now to increase 0.40%? That too in a sudden. And how it is implicated in the Indian economy? I think this is a major aspect, sir. I
Yeah.
expect from you, sir. Narendra, sir.
Okay. Thank you, KK Gupta ji, and all the other distinguished panelists and also the participant. And the subject today is very much relevant and very much important for everybody, because this particular inflation related action which is coming from the RBI, that affects all. And now what Gupta Sahab said, that during the COVID, in order to see that the impact of COVID is not had any major impact on the Indian economy, because you see the first quarter of the economy itself, India had a first time 24% contraction in their GDP. And the full year again, it was more than almost nearing 7% contraction. So that was the first time that the Indian economy showed contraction in GDP. And in the recent RBI report on currency and finance, they have indicated whatever we lost in the last 2.5 years of losses, it will take at least 10 years by 2035 or more than 10 years to recover. That means that our, suppose Indian economy, the current level is around $2.7 trillion of GDP. That part of the losses which has affected the Indian economy will have the major impact. So to that extent, to ensure that everybody passes through the liquidity problem as well as the economy, that the Reserve Bank reduced the interest rates by 115 basis points, and they also pumped in 12 lakh crores of liquidity into the system. So these measures are primarily in relation to the COVID. Even though, even that time, the inflation in the last 2.5 years were always nearer to 6%. On an average, it is 5.5%. So inflation per se has not come down, but the RBI felt as a, what you call, responsive to the growth aspect, because RBI has to play a balanced role between the GDP growth as well as the inflation. So in order to have the growth, and particularly the, what you call, sensitive sectors like MSME or retail or the other poorer section of the population should not be affected, the government also came with the extra emergency credit guarantee and all. That was the COVID part. So the globally today, during the COVID, supply chain also got affected. And when the supply chain got affected, the entire commodity prices started moving up. Today, the container cost, the freight charges, and everything has gone up. Over and above that, the lockdown also globally and India has affected all what you call industrial production, MSME, or all the trade, retail trade, particularly on the service sector, like restaurants or such as the trade, all got affected because they were particularly more than 4 to 6 months lockdown. And now, over and above that, the Ukraine and Russia war has come. Now that has resulted in shortage of food items, particularly wheat. Then it has also resulted in, because Russia is a major supplier of oil, the oil price going more than 130 billion dollars. On an average, it's more than 100 billion dollars. Now, plus the Ukraine and all supplies fertilizer and wheat, and the wheat has become shortage. Now, this impact has resulted in US and all the inflation going up to almost 7.5 to 8%. Similarly, position in the European countries. Now, earlier they thought this inflation is a transitory inflation, it is not going to last forever. So the US was keeping quiet. But recently, apart from the earlier 25 basis increase, they recently increased the interest rate by 50 basis points. And their 10-year yield has almost moved to 3.17. Similarly, the action has come in the elsewhere in the world. Now, India cannot be away from this aspect. So, one is imported inflation because of our oil price dependence, and even in the edible oil we are dependent. Some of the other items like coal, we have become dependent on international, and the coal has also gone up. So in all those things, that inflation has come on India, and you will see the prices of petrol has gone up. Now, over and above that, Indian also has a still the supply chain impact is still there, which is recovery. Now, the Indian GDP the next year got, I think, almost nearer to 9.2% because of the lower base, it got recovered. And in the current year, the GDP, which was thought that it can go 10.5% or that growth, now the Reserve Bank has reduced to 7.2. Recently from 7.8, they reduced to 7.2. So, when the inflation goes up, whether due to supply chain or the supply issue matter, because the demand aspect of the inflation still has not gone. Because demand, definitely, who are all dependent on those raw materials and other things, particularly oil and all, demand is also likely, but it has not gone to that extent it can create inflation. So the demand, because the consumption pattern got affected during the COVID, and particularly now what you call luxury items and all, in this period people may not opt. So that inflation may be under the control of Reserve Bank. But the supply chain, particularly global factor, that is not under the control of Reserve Bank. That can be only little eased only by the government. That is a fiscal aspect of that. But now, even on the fiscal side, India is also a large borrower, and our borrowing has gone to around almost 80% of the GDP, whereas it should be around 60%. Even state government is also borrowed, because during the COVID, for all the social aspects, particularly health, government has to spend. Plus, poorer section has to give a cash benefit. So many things. So now, this inflation, is it a temporary inflation, or is it going to be last forever, last for some more time? Now it looks that it is not temporary. It is until the ease of this geopolitical situation and that overall improvement in the supply and other aspect. For some time, the inflation is likely to be here. Now, so that being the case, Reserve Bank had to make a out of turn, even though in April policy, they have indicated that even though we are accommodative, but other side, whatever benefit we gave due to COVID, we will withdraw in a phased manner. And the inflation also, they have indicated that is already going up. And but never thought that March inflation will go up to nearing almost 6.9. Now, April yesterday would have been given, it is also higher. Now, that being the case, this is, as he rightly Gupta Sahab, that this is the only a beginning. Now, the interest rates are likely to have further increase to take it to a level of 5.15, or there can be even higher. Similarly, that CRR also, even today, 6 to 8 lakhs of cash is still there. So the Reserve Bank has to take that cash back. And but at the same time, the government borrowing of 15 lakh crores of borrowing of the central government has to go smoothly. So the RBI has to play in a way that the government borrowing also goes well. The government is able to borrow at a lower cost. You know, the 10-year yield has gone to 7.36, 7.45. Yesterday, some news came that government may ask the Reserve Bank to purchase back. So that is where the yield has slightly come down. Now, that is how the bank has also increased the rate. If 10-year is going to 7.35, bank cannot offer around 3.5%, 4%, 5% on the deposit. So recently, State Bank increased 90 basis. So your impact will be felt everywhere. Now, if the borrowers are able to pass on their incremental prices of raw material and all, to what extent they can pass on to the customers, and if they are able to pass on to customers, to that extent of the interest increase on the lending rate, they can cover up the margin. But otherwise, they may have to have a lesser margin and still do the business. But for the economy, this will have a definitely impact. and it is, even though RBI has given 7.25 before this increase of rate, so they may come with the revised growth rate, and even though IMF has still says India can have 8%, because our budget has projected 8 to 8.5, but that time they have projected the oil price at $90 per barrel. Today that has become 100 average. So and that time the notional, what you call nominal growth rate, was projected at 11.1. 11.51 means 8% growth, means 3% inflation. Now it has become almost 7. So that all calculation will get little affected. So the Indian economy for some time, but our endeavor of the regulator and the government is to see how that will not be much affected by upfronting their capital investment, upfronting their what you call other expenditure related to developmental, and also taking care of, like you see, the recently also the government has extended the food security, food distribution of around 80,000 crores. They are going free up to, which was implemented during COVID. They are still continuing. So to that extent, they want money at the hands of the people so that the consumption also can go. And this was the period when capacity utilization was coming to in a way where they were to start capex. But unfortunately, the cost of capital will go up. So whether the private sector investment will come through, but government has got more than 111 lakh crores of infrastructure, and that needs the private sector. So they have to find out how best they could control. But for the next one year, the situation is, in terms of the inflation, it can be only little minimized, but that will be on the upper trend.
Thank you, sir, very much. I think you have summarized the position. Inflation as on March was 6.95%.
Yeah.
And you also informed about the repo rate push up interest rates, deposit rate. I think
Yes.
liability side, I think, yes, sir, you
Yeah.
are very, very intelligent man, which we never considered, that the deposit side will be also a hit to the banker, because
Yes.
deposit they will have to increase the rate of interest. And you also rightly, sir, mentioned about the consumption and demand can also be impacted by this
Yeah.
repo rate. I think this is a major aspect. Why CRR is also telling that about what I said, the information here, it is 7,000 crore taken from the consumers. Most of them will also increase. And net interest margin will also change strongly to the what the margin that we had in next year. Some major aspects, as you are aware, this banking group. We are talking about the risk-weighted assets. To determine the risk-weighted asset, bank has to keep some norms for the payment. Now, sir, you are such a experience in the banking sector. So, sir, for risk-weighted assets, how you can mitigate as a minimum provisioning. Have any thought on that aspect, sir, for you?
Yeah. The capital planning for every bank is a very much important, and capital is a scarce item in an item, because the more you grow your investment portfolio, the more you grow your credit portfolio, you have to have a parallel capital, and you cannot be over leveraged. At the same time, you cannot keep idle capital also, and capital has to get risk adjusted return on capital, and that risk adjusted return has to be in a way it adds to the shareholder value and also the stakeholder value. So the bank normally has got, in line with the Reserve Bank regulation on what you call risk weight assets, and also the requirement of prudential norms, they have to have capital planning. And there, the asset liability management committee, and the risk management committee, and the capital management committee, and the financial management department, all of them in coordinated approach. So your business strategy will have to be in line with your capital. So normally, suppose now today fund-based and non-fund-based, there is no particular difference in the risk weights. So you have to see if there are what you call guarantees which are already due and which are not followed up for what you call getting back the original guarantee or following the guidelines relating to that. Some of those guarantees can be cancelled, reversed in that. Similarly, off-balance sheet items, anywhere, any contingent liability and other things, you have to follow up the entry and see that they are also reversed. And the other side, you have to see which are lesser risk at the same time better return. Now, like real estate per se is mostly risky. There you have to have what is the exposure norms. It is not that I get all real estate, I can go on doing, because there are the valuation of the real estate can go down so fast, and in that your distress value realization will be poor. Now, if that is the case, so the RBI also, like even in the real estate in terms of our retail assets also, when the RBI get a feel that it has already been heated up, they normally increase the risk weight to 125 basis points. So instead of 100. So that means they feel that it is already heated up. So the bank also will have to have such a parallel, what you call evaluation, and they have to have the risk asset relating to that risk exposure limits. And accordingly, they have to go. And similarly, what is the entry norm? Can you go in a big way in entry, or what to be the entry norm? So to that extent, my capital can be on a diversified risk rather than on the concentrated risk. So it cannot be only certain sectors I focus on, even on a trade or imported trade or commodities particularly. Then commodities are, during this inflation, they are susceptible to volatility. Now, can the bank can deal in commodities? That is why today, in spite of all that, banks are not allowed to deal in the commodity exchange, because that will have impact on your capital. And so what, because this capital as well as what our deposit liabilities, they are all coming from the normal retail investors. So each of my default risk has a direct bearing on the trust and confidence which I have built up on the customers. So I have to see that my diversified risk. So in that way, Guptaji, that retail portfolio and even MSME portfolio ranks better than some what you call concentrated heavier risk on the corporate side also. But that is why the government said, and the RBI also said, RBI and the SEBI, corporate liability what you call limits above 10,000 crores, such corporate will have to go for 50% of the borrowing from the bond market, and SEBI says at least 25%. So there is a necessity to take that risk to the debt market, or they should also go to the equity market, rather than the bank taking the entire responsibility, because unnecessary on a larger exposure of a single party, my capital gets blocked. So that is where, depending upon the size of the bank and its ability, like there was one rule that the consortium, the minimum share should be 10%. Now that 10% for a smaller size bank, it may be very difficult to give. So they need not go near that consortium. So you can take your own smaller share in the direct banking, so that why should you ensure that you should go be a part of all that higher risk, because the ability to absorb the larger bank such thing are much better. Now what happened during the earlier period was most of the banks had to depend on government support of capital. Now being a owner here, they have given, but the point is, today they have said that we will not now give any capital, because it is coming from the what you call tax income. So you have to depend on market, and if you have to be market, all the market expectation of what you call return on asset, I have to be give, and my return on equity should be higher. If that is the case, I have to have a proper capital planning, and I have to that is where, see, bank like HDFC, they were not much in infrastructure project. They gave only support to the retail and trade and other, bank guarantee and other fee-based income. They were never. Whereas the public sector bank, we gave the very much support to the infrastructure. Now, but the guidelines and the rules are uniform. It's not because you did the infrastructure, I cannot be different. So now, but at that moment of time, that support by the public sector bank has really resulted in infrastructure push, and all were learning in that game. And today, it is in a better informed and better reformed infrastructure. Today, government also felt that I have to also take equity in that. And that's why in the road project and all, they are also taking equity. It is not that just leave it to the bank to take 75% credit and take the entire risk of execution. So in capital planning and risk-weighted asset management is a very technical issue which needs the board direction, and it should also get the engagement of the senior management, and it cannot be left to the lower level. And along with that, the profit and profit planning and the entire balance sheet management through the ALM, through the NIM management, we have to play a very important role.
Sir, thank you very much. I think some banker must be listening to you. What you advise them, I think it is really wonderful. What you are talking about, the whole balance sheet item. I think banker is somewhere they are not reversing the guarantee issued by them. Even that is also playing important role for the risk-weighted assets provisioning. You are keeping much more better informed. What you are talking about, sir, is the most mantra. So I think the highest level of the banking sector, they must see what is the weighted assets. And you also suggested to review the business planning of the banking sector, where the portfolio having the maximum risk factor, that can be reviewed. I think, sir, you are great. What you are, so you are telling, sir, I am welcome back to you, sir. Now I'm coming to Shri Maurice Jain, Managing Director, Finman Advisor. He's CA, CFA, USA. He is the single-handed person who is helping our entrepreneurs in grading their ratings, in increasing the rating. He has a vast experience in the fields. That's just I want from you. Company offer are not well informed on the parameters by rating agencies used to evaluate their business. What step can company take to improve their ratings? I think this is a major aspect, sir. What you are doing it as a company. Just I'm telling you, housing company which are with me, Mr. Prabhu, he had done a wonderful job under the housing parameter. Still, he not getting an investment grade. So, how you are helping, sir, this person? Because I called you, you are the right person to tell our members, to tell our entrepreneurs, what are the parameters and how this parameter can be met and can get at least investment grade. Hand over to Mr. Jain.
Yes, sir. Good afternoon. Yeah, basically rating agencies, when we look at the companies, they do look at the both qualitative as well as quantitative parameters. When we talk about companies from a housing finance company perspective, criteria for Nbfc are little different than a rating for a corporate or a manufacturing companies. So specifically talking about a housing finance company and particularly say a small size housing finance company, how do they get an investment grade rating? Because many times rating agency has a specific size requirement, and many times they think larger the better kind of philosophy is also there. So, but however, we have seen some of the small AUM NBFC companies or housing finance companies also getting investment grade, based mainly because of their positive qualitative parameters rather than the quantitative. Qualitative parameters, when we talk about, for example, a NBFC or a housing financing company can take care or can look at the kind of board they have. So we have seen always that a strong board with the people from the industry, like someone from the bank or someone from the industry at a fund level or someone, people who have a high repute also helps in rating agencies thinking about high on these policies and everything. Second, the management. Of course, many times the small size NBFC might be run by the promoter himself, but if they also have the professional management, that also helps in getting a better rating. At the same time, the quality of asset and the collection and under lending policies. So in an NBFC, the most important part is of course the collection, and how efficient it is very important. Even if it's a low size, they have to see that their GNPA, the gross NPA is low. Of course, the gross NPA is the actual loss, but rating agency would like to see the underwriting strength of the company by looking at the GNPA. So gross NPA should also be tried to reduce as possible by building a high asset quality books. And the most important is the liquidity profile of a NBFC, because liquidity profile can be looked at by looking at their asset liability mismatch. A positive ALM is always required. Second, the cash and bank balance or free unutilized lines available with them, because NBFCs have to keep running their business. They have to keep repaying the loans which they have borrowed, and they have to keep lending to the application which coming in. So they should have enough at least for next 3 months of business cash available with them to make sure they are able to repay the loans as well as to lend in all the possible scenarios. So liquidity is very important. Then, and a good CAR ratio, say industry requirement of a 15%, but somewhere around 25 to 30% of a CAR ratio is also important. So these are some of the things which if an NBFC or a housing finance company take care, I think in a lower size also, whether say 50, 60, 70, 80 crore of AUM also can try for an investment grade based on the various qualitative parameters which we discussed right now. So this was the main criteria for a corporates are completely, of course, different because the business model is also different. So when we talk about rating agencies, a manufacturing side or a service provider, a trading company, what kind of things they have to take care is more or less simple things. I mean, they have to make sure that they are financially disciplined. The payments to bank, payments to supplier are regular on time. That's most important, because many times in India we believe 5-6 दिन delay चलता है. And then of course they have to see that the kind of product they are working or the kind of geographies they are working is little bit diversified. They have a proper risk mitigation strategy. When we talk about the risk, proper say collection risk, inventory risk, price fluctuation risk, and the supplier risk, and the efficient use of working capital. So when we talk about, they have to also see the financials are properly prepared with the right kind of auditors, right management, and the risk, the management appetite for risk also should be balanced. So when they are coming up with the capex or something, there should be a proper mix of equity as well as debt, and the focus on a proper mix while funding their operations should also be there. And I think following a proper corporate governance will also help them a lot. While showing a professional approach toward doing the businesses, and a comfort and confidence in the eyes of rating agency while you're working. So more or less, if you follow the simple practices while running the businesses, even in the smaller size companies, we have seen getting a higher rating without having a proper size. So that is most important. And the last and least, the liquidity management, the unutilized bank lines and the working capital management is most important thing. So this is more or less a company has to take care while doing a rating exercise with the rating agencies. And while running their operations, this will not help only in the rating side, but this might also help while running their operations in the proper businesses in the long run. So this will also help in their sustainability, their stability towards their businesses. Because we have also seen people not following this, having tough time while the situation and economic started changing. So this will also help them remain stable and remain persistent and sustainable in the long run.
Very nice, Jansa, what you are mentioning of the qualitative and quantitative, and talking about the strong board, other things. That's a one point is there. You are giving a rating for a product, not any company. Lekin I seen that product the same, everything is same. If any company give a corporate guarantee of another company, then rating agency give a investment grade. Oh, the rating increased. Although product is same. Lekin when comfort is there, you are increasing it. So how you justified, sir, for this? Because product is the same. Only he is a bank has a comfort, or you are giving a comfort, giving a corporate guarantee of their associated company. If a company has no associate, he will not, never get the investment grade. Lekin if another company is there, he giving the corporate guarantee, and he will get the investment grade. How you sir? Because you are a helm of fair.
Basically, sir, rating, when we talk about the rating definition of rating is very simple.
Sir.
It talks about the probability of paying debt on probability of a borrowers to pay the debt on time. So when we talk about the probability, it is made of two parameters. One is the ability and the willingness of the issuer to pay the debt on time.
Sir.
So when you say the rating, when you are talking on a standalone basis, when the rating agency might give you a say X rating. So this is that probability, ability, willingness remain the same. Ability is that. But the moment someone, a larger size company or a better rated company gives them a corporate guarantee, so their ability improves a lot. Since now they have a support over someone who is higher rated and a higher who has a higher liquidity position, and who has guaranteed something that in case some problem happens, I'm there to support the company and pay the loans. So the ability has improved, and that's why the reason the rating also gets improved for that particular loan, for the loan which is being guaranteed by someone. So that also rating agencies have various covenant to see whether the documents of guaranteeing is post-default or pre-default. That is also very important. It has to be pre-default. They have to come and support pre-default, not post-default. So that is there too. So normally you see the most of the instrument will have a more or less same rating if there is no structure involved. But there can be many kind of structures involved in terms of when you say the guarantees, when you say the specific cash flows for that particular loan, or the escrow mechanism when we say, and various other things where the strength of that particular loan improves because of the assured cash flow available or because of the assured money available in case of requirement. So that improves the ability of the repayment, and that's why the rating improves.
Very nice, very nice. Sir, I'm coming, Mr. Siddharth Prabhu. So you can give your comment on what Mr. Jain is telling. So because you are also a housing finance company, to his viewpoint, I think you must have listened. What do you comment on that, Mr. Prabhu?
Yes, sir. No, sir. What Mr. Jain has commented on the investment rating, the qualitative aspects and the quantitative aspects are absolutely correct, because one definitely has to improve on these particular parameters in order to get to the next level of growth. Once you get to the next level of growth, which is the investment grade, obviously you have better access of funds, you have lower cost of funds at your disposal, and that is how you can probably augment the growth rate of the company even further. So yes, sir, I am 100% in sync with what Mr. Jain has said about
my Mr. Prabhu point is whether you are agreed with the Mr. Jain and have any suggestion, because you are also feeling the pinch for that, because you are not getting it. That is a point. Although you are doing excellent job to give a loan to our organized sector, your recovery is excellent. And how you venture into the business, really, I have been telling so many webinars. Your father, how much he struggled to get the loan, although you are a chartered accountant and you have a professional marriage company, Everything is okay. You are still you are not getting the investment grade. What is your suggestion to Mr. Jain, or what do you expect from Mr. Jain to upgrade your rating? And what is your suggestion to any rating agencies?
So what happens primarily is obviously as Mr. Jain has also said, that the level of the company in which it operates plays a very vital role in the comfort which any rating agency issues his rating. So for particularly our company, there obviously is a constraint, or there, compared to other larger, bigger corporate finance houses. But I think it's a journey which we have to take, which he has also mentioned, indirectly, that what happens is, earlier when the company starts, you get access to funds at a slightly higher rate, and then you have to look at alternative source of investments, or have to look at alternative sources of building your liability side of the balance sheet by looking into other than traditional finance parts. It may be as co-lending, which was recently introduced by RBI. It may be business correspondence route, or it may be even through direct assignment and securitization route. So off lately, not just our company, I think overall the Nbfc segment has been hit by higher cost of funds, and with this interest rate hike, which is done by RBI, I think slowly, steadily, the economy in general will feel the trickle down. So what usually happens is, these rates which are passed on to commercial banks eventually does get passed on to financial institutions, and ultimately to the consumers also. With the government largely focusing on reducing inflation, it wants to make sure that the demand in purchasing the goods and services are reduced, and there's a good cooling period. So yes, obviously in the next near future, there will be a certain challenge. I would say it would not be an impossible task, but it will be certainly challenging for institutions of smaller scales, of mid-level scales, of even larger scales, for access of funds. And I think that really plays a big role in the growth factor also, because then that limits the book size of the company also, in growing the book size of the company.
Very nice, Mr. Prabhu. I'm Mr. Gandhi.
Yes, sir.
I also listen. You also in this infrastructure thing.
Correct.
My point actually to Mr. Jain is, for a startup, you cannot get an investment grade unless you are some माई बाप आपके नहीं है, some assurity company नहीं है, then the bank will reluctant to give a finance for that. Then how a government is helping? What are your views of? You must have listened to Mr. Jain. Have any views for any suggestion from your side, Mr. Gandhi?
Yeah. For hello, good evening to everyone. Can you listen to me?
Yeah. Please carry on.
Yeah. Now you are talking about the credit rating, how banks were able to give.
I'm just talking about the credit rating for a small people, for a startup, for a housing company who is doing very well, although everything is under control, but they have no capital. They have no risk factor. They are telling the higher, so they will not give any investment grade. And for a startup also, they cannot get any investment grade.
So it is like a greenfield project.
Yes. I am talking about that.
Yeah.
What is your suggestion? What do you feel that Mr. Jain should help to you, or rating agency can help to you?
Sir, rating, I think mostly Jain must be aware. The rating will be done by the CIBIL mostly. Rating of the individual people, individual corporates, and partnership.
I'm not talking about the CIBIL. I'm talking about the rating agency, just like CRISIL or CARE.
Okay.
Like that. I'm not talking about the CIBIL. CIBIL is only giving a grade. They are not giving a grade. They are grading the people. What is the percentage of their risk?
Correct. So now getting the credit rating agency, they do it on the basis of projections. What they do it, they give the estimates to the next 4 years or 5 years.
I'm not asking you what is the parameter they are asking. I am asking whether you agree, Mr. Jain, what he talking about.
Yeah, I agree with the Jain. There is no issue. But he has to do the rating in he must be doing a TUV rating also.
Yes.
Yeah. So in that greenfield project, you have to consider the entire aspect of what Mr. Jain said, that quantitative and quality of the project that is to be seen, whether that is profitable, whether it can be considered by the rating agency. It can be seen that.
Right, Mr. Gandhi. Now I'm coming
Yeah.
to sir, our Bishop Pitama, I mean Narendra sir. Sir, what is your suggestion? You must have seen the Mr. Jain. What are you talking about? What is your suggestion, sir? My only point is, for a startup, it is very difficult to get a grade investment grade. Or
Yeah.
a small company, you cannot get it. If he has no associate or corporate, he cannot get the thing. What are you thinking, sir? You have such a big experience with you. Have any suggestion?
No, yeah. What I mean to say,
Sir.
that the smaller, suppose like Prabhu is a Swagat housing finance for retail asset.
Sir.
His what you call cutoff point of lending also will be in the what you call affordable housing segment or even lower segment. Being what size of capital he has got, I am not aware. Depending on the size of capital, you have to select a niche segment which you are going to finance. Suppose some of them in the microfinance, then they are going to lend in 25,000, 5,000, 10,000. Same way, this housing, maybe even rural housing, somebody may need 1 lakh, not more than 1 lakh, 50,000. So, or if it is a city related, then naturally you have to increase your capital. Now, as a startup or from your source, you cannot get capital. Now, ideally is, why not we select a collaboration approach where I tie up with the other, like what he said also, that co-lending and other things which RBI has penetrated or started or enabled. Other than that, I am a high net worth individual, or there is some venture capital investor. There can be what you call private equity, but I am not aiming at a big private equity like which look at a very structured deal and all that. But I will look at somebody whose capital I get as a supporting for his interest in getting in the return. Now, if that the rating agency will see who are all involved in the capital support of this particular housing company, and if the other investors also do carry as that of the promoter of the company, then the rating agency will have a better perception. And similarly, what they are seeing in the sense, to what extent their exposure limit they are likely to take in the real estate, that personal segment, and they will not like to go for wholesale segment. Even in housing finance, somebody is going to wholesale segment, then naturally the rating agency will not give them better rating, because it has been proved that all the housing finance as well as what you call all the Nbfc who have gone for wholesale segment after the ILFS crisis and other crises, now they have completely said that we made a mistake, and they are now going for retail only. So,
sir, even if at DHFL also.
Yeah, DHFL also.
Yeah,
so,
correct.
and India Bulls, everybody
India
now
Bulls,
they are not likely to go for wholesale. So, if
Correct.
our Swagat, definitely he will be in the retail. So, he has to see what are the rating agency expectation of comfort. Or suppose, I am a banker to the Swagat, I will say that I will give him some what you call credit enhancement. I will give him that, okay, this company, I am willing to take exposure to that extent. And if I give that comfort, rating agency will also say, okay, subject to that, with that credit enhancement, I will like to give a better rating. So it all goes by, as he rightly said, the comfort of the rating agency. But now, if the rating agency becomes too liberal in rating, tomorrow when the default takes place, we will also scold the rating agency. So they have their counter partner, like now CRISIL has got S&P, now like others also has got Modi and all that, what you call the international Moody rating and all. So they will follow some their own local as well as international standards, and accordingly they will come. But the Mr. Manish role comes, where he will not only educate, he will also see how your rating can become better. And Manish will play an important role because of his experience in handling these live cases. He will suggest, okay, we'll have a 6 months process by which we'll see that your rating will improve. Now, that are the tools which have to be followed by the company like Swagat. They will get.
But sir, initially,
Yes.
for rating agency also, if you have a joint venture, then rating agencies are more ready to do it. Otherwise,
Yes.
they simply say we are not able to get it done. And
like अभी आपका
it should be a retail. They give you correct.
आपका infrastructure में the SPV will have to have the support of the holding company.
Correct.
And if the holding company, what is the net worth? Are they positive to net worth and all that will be seen while giving the SPV on its own standalone also.
And
But sir, in greenfield project, normally people are reluctant to do the giving him the startup activity.
वो सर greenfield के लिए separate rating parameter है.
Yes.
And the brownfield के लिए separate parameter. Can you, Manish, can clarify? Yeah.
Right. Yeah, 100%, sir. A greenfield, a brownfield, a Nbfc, a infra company, a real estate company, all have a different way of analyzing ratings and a different way. And also, Gupta ji, please appreciate rating agency has an investment grade 10 rating scale and non-investment grade also 10 rating scales. So some people will always be there on non-investment grade, and there will be a criteria towards achieving on a higher grade of the rating. So, and definitely we cannot expect everyone to get an investment grade rate the day they start. We will have a process to run. Of course, as I told earlier, there is something apart from size which a company can follow to try and improve some part of the rating.
So that means that will take another 5 to 6 months to do the rating also.
Of course,
definitely. It is more than that.
ये rating है ना, rating is one somebody is taking rating only because the bank wants the rating. Another, somebody is taking rating to benchmark himself or the company or the product or whatever to see where I stand and when I have to go on improving. And so sometimes the rationale given by the rating agency will act as the motivator for the board or the promoter or the company to take some steps to improve the rating. Similarly, there are sector specific. Company may be very good, but sometimes the sector is under high rated risk. Then that will be high on the rating agency. And this particular company, even though exceptionally good from others, even then that aspect may affect them. Suppose somebody is in a commodities business. Today, what is happening globally also. Then suppose today steel sector, we may get good rating because steel sector is giving now better margin now because of the recent, the price increase and all. So like that, they have to keep the global macroeconomic, domestic macroeconomic, sector specific, so many parameters. So they are also learning. In fact, rating agency also learning. It is not overnight they can have the full feel of all that. So they will collect as much data from various companies, rated, unrated, and then arrive at certain parameters and within their overall guidelines, standards.
But sir, I have seen that normally banks are asking for the rating. Normally, for any greenfield project or any existing project, also normally all the nationalized bank and they are asking for the rating to be done.
Bank के लिए rating बिना we cannot funding
because
our risk weight is depending on the rating.
Yes.
Until that risk weights are not linked to the rating and the regulator not insisted for rating, we were lending without the rating because we have our own capability for internal rating. Right. So now the regulator has said that I can have the risk, what you call the overall supervision on your own internal rating patterns, provided you develop that your rating pattern on a very sound footing. So it takes some time for that. But until that, we have to depend on the external rating. Yes, sir. Gupta ji.
Sir, thank you, sir. Thank you very much. I think you are rightly told Yeah, external rating is a must for that. Banker without investment grade, they have never touched even the proposals. Mr. Siddharth, that's why I'm asking as a housing company, so this rise in interest, how it is impacted? I know that your EMI must be increasing. What other effect can be there, sir, while you are financing to the company or you're getting loan from the banks? What are you feeling, sir, for that,
Correct.
Mr.
Correct.
Prabhu?
So see, yeah, sir. So so higher rate interest, which is currently happened in the recent couple of weeks or last week, obviously there will be a very stiff competition among financial institutions in the next near term, which will put further pressure on the interest margin, and it may negatively also affect the bank profitability and its ability to further grow the book. We need to first understand the fact that there are certain factors, internal factors and external factors, both which can affect the profitability of the bank or the profitability of the book. So obviously the internal factors certainly include the interest factor, which contributes to the interest income, the operational efficiency of the financial institution, the ability of the promoter or the ability of the stakeholders to increase the capital, which further contributes to the capital adequacy. And obviously there are macroeconomic factors like GDP growth, the rate of inflation, and interest rate. So one of the pressing issue currently with the interest rate hike on the banks is the Npa management. And along with Npa management is to maintain the growth of the company. So in the recent terms, I think with the COVID pandemic year, the last 2 years, in a recent study report by Boston Consulting Group, it was mentioned that the NBFCs have largely maintained good asset quality. This is primarily because the write-off percentage in the last 2 years has significantly increased. Uh, just to mention you in terms of the percentage, I think the percentage of write-off uh, in financial year 21 compared to financial year 20 was 70 basis points higher. This was this was mentioned in the BCG report, which compiled articles from various rating agencies and economic survey report. So obviously for the NPA management and the growth of the book, one has to obviously identify the risk. One has to ensure that there are adequate controls. And particularly regarding this scenario, which is the interest rate hike, bigger financial institutions and they definitely have a mechanism of sensitivity testing and various other scenario testing platforms. So obviously, what one company does is identify the stress factors, which is currently the higher interest rates, and applies it in the various credit assessment parameters which they have as per its policies and what is laid down by this board and committee members. And it tries to make sure that the financial institution is able to maintain a good balance between the external factor stress, which is currently the higher interest rates. As I tell you, as probably spoken by Mr. Narendra ji also, that there might be a scenario that, and we are also very likely to see that there might be a scenario where the interest rates are further hiked in the next 1 or 2 months when the next monetary policy committee meeting is held. And this is obviously to understand, this is obviously to mention for the fact that to reduce inflation. The underlying thing which we also need to understand that this pumping of liquidity which has happened is probably because of the COVID pandemic. At a point of time where it was a once in a lifetime scenario 2 years back, the government at the RBI has very wisely reduced the repo rate, and now it's slowly, steadily increasing, and it might increase further also. So obviously, every financial institution has to undertake certain stress testing and scenario analysis to make sure that they are able to adequately maintain good asset quality in their company.
Very nice, very nice. Apna, what are you talking about the management of the stress assets. I think this is a major aspect in the housing sector also. So, I'm coming to Mr. Gandhi.
Yes, sir.
Gandhi, you are the helm of fear of infrastructure financing, something like that.
Yeah.
Now, this floating interest rate, definitely cost will go up. So, what is your suggestion? Whether there should be some fixed rate for that, or any other suggestion, so that the cost of productions or cost of sale should not be increased. What is your suggestion for that, Mr. Gandhi?
Sir, in my opinion, fixed rate financing is a better option for companies. They keep the payment same for the each month. Secondly, making the budgeting more easier and keep the borrowers in them on monthly payments. Third, it helps the borrower to determine and predict their cost more accurately. But sir, however, this option may not be right for everyone, but it is definitely worth considering those companies struggling up for raising interest rates. So I think we should go for a fixed rate financing.
Okay.
And that will be helpful in a longer period.
Even, sir, Mr. Gandhi, some this infrastructure industry, I seen some more assets they are building up, which is not useful immediately for them. And they are building up the inventory unnecessarily with the hope that further speculation will be there. So you must be knowing all the things. So what
Right.
have you any suggestion to these infrastructure companies or company which are maintaining the high inventory level or a core assets, core non-current assets, which is no use for the company. It is not having any production, something like it, not having some results, you can say, doing it. And what is your suggestion? Whether they should keep such a huge inventory or non-current assets?
Sir, I will tell you several steps we have to take for managing current and non-current assets.
Okay.
So first of all, we have to develop an inventory of all company assets. Like inventory includes description of each assets and their current value. Then you categorize each assets according to its type, like cash and bank balance, then account receivable, then stocks, then prepare expenses on liquidity basis. And after categorizing the assets, determine the net carrying value. That is, net carrying value means asset is worth after taking into account of depreciation. Okay. And finally develop the plan for managing each type of assets. This is how we can able to manage current and non-current assets.
Very important, very important.
Yeah.
But what do you suggest for the non-current? Where is non-current mean? Which is not used by the company. It is idle assets, you can say. They are building up the assets for a future speculation, for a future profit. So,
sir, in infrastructure company, their non-current assets maybe like they have some old JCB machine and which is not useful at all.
Okay.
That kind of they have to sell their assets and get a new one to effectively do the more contractual work.
Okay. Thank you.
Yes.
So, Mr. Jain, Manish Jain, Dr. A.K. Singh is writing the rating are not very much reliable. Excellent rated account turned NPA within 6-month period. Have any suggestion from your side, Mr. Jain?
Yes, sir. Basically, when we talk about the rating, only on the bank loan rating scale, I mean, the SME rating agency do more than a lakh rating a year, and on the larger rating scale, rating agency do more than 42,000 companies a year. I understand when you're running a certain business where you're giving opinion, accident do occurs. But having a 2 or 4 accidents cannot be and should not be considered as a complete process and reliable, because when you look at the data and when you rating agency also do the default studies every 6 months and publish on their website also. So if you see the AAA rating will always have the lowest default ratio as compared to a triple B or a A rated or a double B rated. So lower the rating, the default ratio will always be very low. And this has been being monitored by SEBI, RBI, rating agency, all on a very 6-month basis. And it has to be published on the website of the rating agency also. So definitely defaults are going to happen. Many times you do not know the exact when, and many times the call might also, sometimes the call might also be wrong. But of course, the system as a whole, the SEBI and RBI has a more confidence on the rating agency nowadays. For example, recently rating agency 2 years back started a RP rating also. RP rating is a restructuring rating. So now what happens, earlier any bank whose the loan was going for default, rating bank were directly doing the restructuring. Now if a company have a more than 100 crore of exposure, rating the bank before doing the restructuring, they have to take a rating also from the rating agency, and if it is certain rating has to be a certain threshold level, then only restructuring can be approved. So this also shows the confidence of the regulator on the rating agencies, while they are giving more work, and now they have also introduced one more job to the rating agency for all the IPO proceeds which the companies are getting. Rating agency have to do the audit and tell whether the money has been used for the purpose which has been raised. So all those jobs which were not available earlier are being given to rating agency. Also shows the regulators' confidence on the rating agency. And also when you look at the default studies and everything, you will also have a lot confidence in the rating agency when seeing that very fraction of the total rated profiles get defaulted on a particular rating levels.
Sir, nowadays, even they ask for the CS certificate to certify all the expenditure, what is been done.
Yeah, that is okay. Lekin major point is you see so many company, a AAA rated company has gone.
Yeah.
Yeah, but there are of course 4-5 names which we can talk about which were AAA and defaulted,
Yes,
but not many.
not many.
So, Muktaji, what happens, the promoter or the directors and all, at what time they take some decision which are, in a way, have some additional risk. Now, that risk, whether the banker or the what you call company, rating company, sometimes are not able to capture, because ultimately business is done by the company. Now, so if at all whatever they have told to the rating or the bank, and beyond that, as he rightly said, core and non-core, कुछ ऐसा पैसा अच्छा आता है तो सीधा वही एसेट में, पर्सनल एसेट में, शेयर मार्केट में, स्पेकुलेटिव ट्रेडिंग में सभी डालता है. Now that even though bank doesn't know, because it may be that out of their profit also, whatever, and with or some luxurious things, and then when you really need money, you don't have money. और कोई अच्छा सप्लायर आपका एक डेटर है, वो सडनली आपने एक ही आदमी को सप्लाई करते गए और वो डेटर फेलियर हो गया, तो ये आपने तो फेस करेगा. तो बट one point is there, rating agency also sometimes reactive rather than proactive. So they have to be in line with the market information. They have to have a more disclosure from the company, and they have to monitor. Not the rating case दिया और पैसा बनाया उसके बाद भूल गया, वो नहीं है. They have to also monitor, and that's why the quarterly information, everything, even at the bank level. So this area has received more attention after large NPA coming today. That is why the RBI also, even 0.30 to 60 days, 60 days to 90 days, उसका पूरा वो return जाता है. So the moment 60 हो गया, then it is already showing signs of weakness. So the signals are captured so that the bank can take immediate action. Yeah.
Like station.
Yeah.
Sir, apna Narendra sir, some question there. Rohit is asking.
Yeah.
If the inflation is cost push, then why increase in rate of interest?
Yeah. What I mean to say that whatever action which is coming from the Reserve Bank, that acts as the what you call surprise, and the very action of the RBI that they are willing to control the inflation, because that is the price stability and the price what you call control. is the basic function of the RBI.
Right, sir.
Over and above that, the central government through the parliament has given them target of 4% as the what you call inflation. Beyond that, they can go another 200 basis up or down. So when they exceed above 6% on an average, then they, after 3 quarters of such push, then they have to explain to the central government and to the parliament how they were not able to control the inflation. So the RBI abhi ka action is not necessarily immediate action. They will, that the inflation, the expectation itself, that has to be controlled. So the incremental inflation will get at a slow pace. The moment RBI has taken, the other side, some supply chain has to be improved and all, government will do. So no action alone, only just by the overall imported inflation, I don't have any say, aisa nahi bol sakte, because there is a liquidity also. They have to suck up the liquidity. They have to also manage the exchange rate management. They have to see that not the exporter only get benefit. They have to also see the import bill don't go up. So in all that respect, there is a larger policy prescription for the Reserve Bank, and to give different signal at the different time. And today they thought increasing the repo rate, and actually in future also, until that comes under control. And meanwhile, the RBI government action will follow. So with that, they want to bring down the inflation within the maximum range of 400 basis to or up to 5% average. That they will do.
Right. Another Shashikant is asking Kothari sir, how much the repo and CR hike will affect the infrastructure and real estate sector?
Yeah. Now, the real estate sector is the core sector which leads to all the other core sector growth, like cement, steel, everything. So the real estate sector is one of the very important sector, and the construction sector, like the road, bridges, infrastructure, all that. These two are to be active, and that is they are also employment oriented. There are a lot of construction workers, migrant laborers. All of them are dependent on the real estate and other road infrastructure project. So one is the government, that's why are spending on the infrastructure, like the last year that was 5.5 lakh, 50 lakh crores. Parallelly, they supported the state government also, and this year they are spending 7.5 lakh crores only on the infrastructure and the capex, like road, railways, port, airport, all that. Plus, they are also giving 1 lakh crore of long-term loan to the state government. Overall, around 10.68 lakh crores, which is around 4.1% of the GDP, they are spending on the capex, because that has got a multiplier effect. It will again support all other sectors. So in a way, when the inflation goes, the cost of capital going up, the real estate sector also will increase their already, like cement price, steel price already going up. Real estate sector has increased the final price to the consumers, and there is a buoyancy in the personal purchase of real estate. And in Bombay, per month around 11,000 registration is taking place. Now the last 2-3 years were very good for the real estate sector. Now and the banks were also lending at 6.40, which is a very good rate. Now that all will become slightly costlier, but if the disposal income of the individuals will have to go up through some salary increase or the professional fees increase, then that can match the EMI. So it is not that today itself we have any risk of default, because if you see the pre-COVID, interest rates were already 5.15, and that was not so bad. So I am sure a reasonable increase in the interest rate, even all will bear. But if it goes to like today, Sri Lanka and all, inflation has gone to 20% or maybe beyond some other place, even in some countries. Now that situation, India will never come. They are much in control, and we have seen 11%, 12% inflation also. Now, of course, there are core inflation. There is a wholesale price index that is still at 14%, average 13%. So that is mainly this oil and all, your petroleum, diesel, all that. So now Everywhere the poor and the middle income group will get affected, and that may have some impact on the consumption pattern, that may have impact on the GDP, which I mentioned in the beginning. But the real estate sector and the construction sector, in terms of the cost of their investment, that will go up.
Even sir, infrastructure also they are doing very well. The Delhi corridor, Delhi Mumbai corridor road, and Nagpur and all that. They are
around 8
yes,
industrial corridor will be coming. 8.
Yeah. So that will definitely more.
Lot of opportunity. Lot of
yes,
industry,
lot of opportunities.
Lot of
infrastructure is playing very important role for development of the economy.
And that PLI manufacturing hub itself is big scheme.
Yes.
It is going a big way. Sir, one Mr. Shri there, he raised 3 issues. I think that is interlinked with one another. Is monetary policy less effective than interest rate or persistence low? Then he is similarly asking, how does hike in repo rate affect the bank? MCLR definitely going to affect. While will external benchmark link lending rate also if repo rate is hiked? I think this is similar to the question of 3. Have any views, sir?
One is our the bank, as I rightly said, yes, if you want resources, you have to give them real rate of return,
right?
Not negative rate. But right, only during COVID they were giving negative return in the national interest of economic development and what you call revival. Now, if you have to give a real rate of return, you have to increase the deposit rate. Now, which State Bank took the lead, and they increase the rate up to 40 to 90 basis point. Now, if they increase the liability cost, that the marginal cost of funding will go up. And similarly, if some bank is only borrowing in the call money rate also, now the rate has from 3.35 or whatever 4%, it has gone to 4.40. So automatically, when the RBI also suck up the liquidity, automatically they have to depend on call money or the term money and all, the rate will go up. And similarly, if they have to raise bond, again corporate bond and the government bond, as well as the banks tier 2 capital bond, again the coupon rate will go up. So overall, the cost of funds the bank will go up. Then they have to necessarily increase the lending rate. So it acts as the what you call proportionately. Now all the deposits are going to mature at a later date, whereas your assets will get repriced. So when that being the case, your overall, suppose it is the interest rate coming down, the deposit rate which are taken at a higher rate, that will continue. So bank has to parallelly for incremental deposit, they have to give higher rate. Now at that higher rate deposit will have to be invested in higher rated investments or higher rated credit. So in order to see that overall they cover up their whatever NIM, they have to make a balanced decision. But it is not that entire cost gets passed on to the borrower, nor entire the lesser rate is paid to the liability. So they have to necessarily follow. Now, if it is a any benchmark rate return, it is in direct proportionate to the 10-year yield or 5-year yield and or a treasury bill, whichever we have taken as a benchmark. And it is a very transparent methodology by which interest rate, either positive or negative, will be passed on to the customers.
Very nice, sir. Sir, lastly, just you see SC Agrawal. I don't understand what you want to say. White money or something like that. Have any views, sir, for that?
हमने देखा ना, ये क्वेश्चन आंसर में है.
हाँ, क्वेश्चन में है. Mr. K.K. Gupta, Mr. Jain, Mr. Gandhi, Mr. Narendra, and others. He asked for everybody.
अच्छा, एक मिनट. क्या पूछते हैं?
What is his question? What is his question?
I will see. Borrowers have to go to banks for or NBFC or lending companies because they do not have white money with them. Suggestion is to introduce new head of income in the return of income, where a sum of rupees 10 lakhs can be offered every year as income without attracting any interest and penalty. This is the suggestion. Then ye to that sometime back amnesty scheme has been provided by the government, where at a particular level of time they said that you can some of the whatever income you have not disclosed, you can
declare
disclose,
that.
and
can declare
you will be given amnesty. And I think that one provision even in the current budget, that they said that I think it is there, that you can reopen your earlier assessed income tax case also, and you can resubmit the return, provided you have somewhere some of the items of income and all you have left out. But ये white money, black money, ये सब है ना, it's not a correct methodology.
It's not a correct position, sir.
It's not like that. See, it is a, suppose somewhere not like tomorrow, today, some of the you're a sweet merchant and all that. Now, when the GST has come, all have come under the particular category of taxation.
Sir.
Or sometimes somebody may be doing business without any record, not because he intended. He is in a way, it is his trade. Today he has to be educated. Similarly, there are wealthy people, sometimes they may not follow the guidelines. Now that is where the compliance has become very much, and with the compliance, now the GST has gone to 1.6 lakh, 6.6 lakh, I think 64 lakh crores. So that has going up. Now just from 1 lakh it is going up. So we have to be compliant with our whatever government guidelines. And but his point is again wrong, that it is not because you are not declaring or anything. Everybody needs the bank's support, whether in a small 1 lakh loan or housing loan or personal loan or consumer loan or a MSME or mid corporate, large corporate. Banks are the one which gives out of their own what you call savings of the depositors to those who are in need of money, and cover up the cost by way of interest spread.
Very nicely, sir. Very nice interaction. I think today webinar is a practical webinar. We talk in depth all the rating. We are talking about the inflation. We are talking about the effective economy, infrastructure, rate of interest. We have talked. Sir, because we have overstretched, I will not ask any other questions. I think we have nicely covered everything. So at the end, on behalf of the Association of Financial Advisors of India and Research in India, I express my gratitude to our eminent panelists, Shri M. Narendra sir, Shri Siddhartha Prabhu, Shri Maresh Jain, and Mr. Gandhi. I think today's session must be very useful for our listeners, and we talk from our heart. We never talk any bookish, other things are there. Our questions we raised by the eminent participants also, we have replied. So I'm also thankful to my back team, Rohan and his team members, for making excellent arrangement and giving a proper feedback to us. I'm also thankful to my members of the associations and stakeholder, bankers, and my friends who have participated in the webinar, who are giving us a feedback. So we live on your feedback, and please give us your honest feedback so that we can improve our webinar. On the basis of your feedback, we are conducting every week webinar, and this is our 14th webinar. I further request the participants to become a member of our associations, which give us a strength to negotiate with the government, we negotiate with the IBAs, so that our association can be have recognitions, so that we can have same say and we follow the ethics for which this association was formed. We are also talking about the research in India, where we are a debt syndicators, we are a ranger, we are a merchant banker, we are investment banker, we are giving a training to the banks and PSUs. We are also in solvency. Another sector we are doing it. Even we are preparing DPR and conducting a technical economic Bible study. If anything is there, so you can approach us to Research in India, and I will also request to become a member of our associations. So lastly, I'm thankful to all my eminent personality, all the panelists. With this word, I close the session.
So we also thank
Yes, sir.
Uttal Sab and Resurgent and
Thank
all
you,
the
sir.
other.
Sir, your blessing is
panelists.
always required. Thank you very much, sir.
No, both young and energetic panel
And,
hai. Both
sir,
badhiya hai. All the
actually,
best.
for this webinar, I have not called a banker, especially other banker who's sitting banker. I have invited all the youngest person, Munish, he is youngest man, and
Yes.
having a excellent knowledge for the rating. And I called Prabhuji. His father used to come. So I asked him, my father, no, I want your son to come. He also chartered accountant, dynamic personality. And we call Mr. Gandhi, who has a vast experience in the field of consultancy. Thank you very much, sir.
Thank you.
Thank you, Gupta ji.
Thank you, Gupta
Thank
ji.
you,
Thank you,
everyone.
Gupta ji.
Thank
Thank you, everyone.
Thank you.